All right, everybody, welcome back. We're going to do a recap on calls. So, a call option gives you the option to buy or sell, depending on what you want to do. Okay? So, if you're a call buyer, you want the stock to go up. And if you're a call seller, you want the stock to stay below where you sold it. So, if you sell, for an example, the 38.10 right here, if you sell that option, you need the market to stay below 38.10. And as it goes by, the amount of money you sold it for is going to decay. Now, if the market rallies and comes up above your strike, it's going to gain in value. You can see as the calls go deeper into the money, they get more expensive. Well, if you sold it, you want it to go down. So if I was to sell the 38.10 call, I would want price to stay underneath the 38.10. The longer it stays underneath the 38.10, the more it would decay, and then I could buy it back cheaper than where I sold it, and that's where I would make profit. Okay, so if I buy a call, then I want price to move up. All right, I want this call to get more expensive, and you can see that if price was to go up, say I bought it at 3,800, and price was to move up 4 strikes to say 38.20, that would put us 4 strikes in the money, because if we went up, 38.20 would now be at the money, and our option would be deep in the money. You can see the deeper in the money option is worth more money, and that's what we would want. So if I bought the 3,800 for 36.40 and we moved $5, I could sell it for a profit of $39. So I bought it for 36, sold it for 39. I would make a profit there. So when we buy stocks, when we buy options, we want the stock to go up. If we sell option, we want the market to stay underneath us on the call side. All right, so that's just a short, quick recap. Remember that you are doing options contracts. There is an actual contract, even though you're not sitting down doing some, Faustian contract where you, sign your name in blood. It is a contract. What are you contracting into? Well, if you buy a call, you're buying the right to take somebody's shares from them. If you sell a call, then you're selling the right to somebody else that they can call away your shares. Now, options were designed long ago for people to trade stock differently. Now, in today's world, we just trade the option. A lot of people do with no glimpse or thought at all about the stock side of things. So if you're only just buying and selling options, that's one way of doing business, and there's nothing wrong with it. But on the other side, you can use these calls if you own stock to help get more money from your stock. Say you're in a market that has really been going sideways, it just hasn't really been doing anything for you, and you own a lot of shares. If you own at least 100 shares, then you could go and you could sell a call against those. You're basically selling somebody the right to take your shares away from you if the market gets above your sold position. Okay, that is calls in a recap. So now let's talk about calls in a spread. This call is a very expensive call. If I wanted to buy this, it would be $3,690. That's expensive, guys. Right? You're on the hook for all of that. But what if we wanted to trade bullishly in the SPX and we didn't want to just buy the call? Well, we could buy a call spread. So I could buy one option and I could sell another option. This gives me a debit spread. All right. Now, whenever you build any kind of spread, you always want to be able to answer the question, where's my break even? What do I need out of this market for this trade to not be a loser? Forget profit at this point. How much do I need the market to move for this trade to not lose? You want to know how to calculate those numbers, but depending on your broker, it's going to tell you the numbers. So right here, the break even for this trade would be 38.03.30. If the SPX makes it at least that far, by expiration, I will be in a trade that is not profitable but not a loser. All right. If I want to see profit, it's going to have to go farther than that. There is a max profit on this. We can only make so much money. The way that we can identify how much money we could make is look at the width of the spread. I have a spread that's $5 wide. This $5 spread is going to cost me $3.25 to buy. Well, we always have to account for all of the money in the trade. And just like in algebra, if you have 2 digits, you can find the missing digit. We have the width, we have the debit. Now we need to know what our profit is. Debit, you could consider to be max loss, so the other side would be max profit. If I have 325, if I subtract that from $5, I get 175. My max profit in this trade would be 175. Because if I add 175 to 325, it makes $5. Okay, so that's how we can identify our max profit, our max loss, our break even. Let's talk about that break even again for a moment. If I go in here and look at this, we can see that the break even is 3803.25. Why is it that number? Well, if I take 3,800 and I add what I paid, that becomes the break even. I need stock to get that far. So every single time you go to build a trade on a debit spread, you know now that the one that you are buying, you can take that number, 3,800 strike, and you can add the debit it wants you to pay, and that would be your break even. That's how you can get that number. So if you're on Robinhood or some other broker that maybe doesn't tell you your break even, you know now how to get it. But here's the thing. With a debit spread, you can never make max profit because it would mean that your options are in the money, and if you hold an option into the money at expiration, you're going to get assigned. So you could get near max profit, but you could never get the actual max profit. Another thing to keep in mind is that you can shift where you build the trade. Okay, so you don't have to necessarily build it like I did. You could build it in the money, you could build it out of the money, you could straddle the money. Okay, so debit spreads can be built all over the place. But keep in mind where the ask is. So if I have this trade here, I have the 38.15 and the 38.20. And we're going to say that I bought that for $3. Well, if we take 38.15 and add $3, my break even becomes 38.18. And I would need the market to move up to 38.18 just to be at break even. I wouldn't even have profit yet. Also keep in mind how much you're risking versus how much you think you can get. If I have 3 of the $5, then the $2 is my max profit. Okay, so I could go back here and build this one. It also has near $2 max profit. We could try to work the order, get a better price, and yet this one requires much less ask out of the market. I could also go deeper in the market. Okay, now this one is going to cost me a lot more. My max profit is a lot less, but I don't have an ask attached to it. I don't need this market to do anything except stay above my break even. And again, where would that break even be? 37.85, add 3 to that. So 37.88.70. And as long as we stay above 37.88.70, this trade will make profit. How much profit is something that we can discuss also. If we take that over to the Analyze tab, kind of just delete some of this stuff in here, clean house a little bit. Here's that 37.85, 37.90, and you can see where the current market is. That's that gold line right there. As long as we stay above this pivot point, we would make, quote, max profit in theory, right? Remember, we would never actually want to attain the full max profit, but we could get close to it, and then we could close the trade, say, before expiration, a couple hours before expiration, a couple of minutes. But that's the beginning of the conversation about trading call spreads. I am starting with the call debit spreads because I think this seems to be easier for people to grasp. But we'll also be getting into call credit spreads. We're going to do a one thing at a time, right? So this was a two-part video where we recapped everything that we had talked about in calls, and we now started to introduce the call spreads. These are just verticals. Now you could call it, the bull call spread or the bear call spread, but those are really childish terms. They're completely incorrect. What they're doing is labeling your bias into the trade. When you build a bull call spread, you're building a spread that's bullish. Nobody cares if you're bullish. No, get those names out of your head. Those are completely inappropriate terms. So don't use those. If you're building a debit spread on the call side, call it what it is, a call debit spread. Everybody will understand what it is when you say, I built a call debit spread. You could use industry language too, and you can say, I'm long in a call spread. Okay, everybody would understand that, right? Why are you long in a call spread? Because you bought a call spread, right? Now, I could say that I'm long in a put spread, and I could go and buy a put spread, right? And that would make perfect sense too. Why? Because I bought a put spread. Now, if I'm long in a put spread, that actually means I'm short because I bought a put spread. It means I expect the market to go down. But my language would be I'm long a put spread because I bought a put spread. And that's how the industry talks about these things. But that seems to be really confusing for traders. So we don't even use that kind of language because it just confuses retail traders. So just say what it is that you bought or what you sold. If you've got a call debit spread, just say I've got a call debit spread. If you have a call credit spread, just say I've got a call credit spread. Everybody will understand what that is. It's literally the name of the vertical. But you could just say you've got a vertical spread. Okay, so what you don't want to say is I've got a bull call spread or a bear call spread. That just is completely inappropriate and again, not what you want to use. Okay, a little bit of a side jaunt there. All right, so a lot of people ask quite often, well, what's the right way? What's the right way to build a debit? What's the right strikes to use? Guys, there's no wrong ones. There is absolutely no wrong ones, right? What you do have are a couple of industry standards. Okay, so if you build a spread in the money, you don't have very much ask attached to it. And if you build the spread out of the money, you do have a very large ask attached to it. You need the market to make a move. Okay, but the one out of the money has less risk dollar-wise. You're risking less money, and it has a bigger profit potential. The one deeper in the money is risking a lot more money, but has less profit potential. Okay, now when we talk about risk, it can get a little confusing. I'm risking a lot of money here, but my risk is less when it comes to could I lose the trade. I don't need the market to move in this trade. I just need the market to stay over my head. So I need less from the market. That makes it less risky. But there's more risk in the trade. There's more money at stake. There's more money at risk. A trade deeper out of the money, this one holds less monetary risk, but it's a riskier trade to take because I would need the market to make a strong, solid move to get this into the money. Right? So this trade is more risky, but it is holding less risk per monetary dollar. Neither one of those are, quote, right or wrong. Which one would you rather do? Some people are very risky, and some people are not very risky. And now you would be able to choose for yourself, how risky do you want to be? Okay? If you build it at the money, then you can be near the middle. Okay, this at the money is going to try to offer you the most balanced opportunity between that risk and that reward. So what you're trying to do if you build a trade at the money is you're trying to find the closest place to get a 1-to-1 risk to reward ratio trade. Remember that this is a $5 wide trade. So if I want a 1-to-1 risk to reward ratio, then I want to risk half to make half. Okay, if it's $5 wide, I want to risk $2.50 to potentially make $2.50. And we can see that it's not giving me a fair price. I'm building it at the money, and it says that I would have to pay $335. I shouldn't have to pay more than $250. That's an inappropriate price. I would not want that trade. It's too expensive. They're asking for too much money there. And it could be because of the extrinsic value. It could be because of the implied volatility. We don't always know the why behind it, but we do know that if we're building a trade with one option in the money and one option out of the money, if we are straddling price, we want to get half the width of the spread. And if we don't get that, then we can consider this to be an inappropriate trade. It's too expensive. They're asking us for too much money. We wouldn't want it. We could either walk away or find another spread to trade. We could look somewhere else. We could look up the chain or down the chain. Okay, so we could try to find another opportunity. Okay, so that's it, guys. That's the beginning of the vertical talks on calls. I appreciate your time and look forward to seeing you at the next video.